And welcome to View on the Market. I'm your host, Jeff Zayas, and I'm pleased to announce our new show, which focuses on investing your money and how to make it work for you. My host and financial advisor is Jim Dowd, founder of North Capital, Inc. North Capital is a registered investment advisor company based in San Francisco. They develop comprehensive investment plans, manage portfolios for individuals, families, businesses, and nonprofit institutions across the United States. So, without any further ado, let me turn this over to Jim. Jim, how you doing? Can you tell us a little bit about your background?
Yeah, I'm doing well, thanks, Jeff. Yeah, so I've been an investment manager and financial advisor for the last 27 years. And I started North Capital about 3.5 years ago to focus on bringing institutional quality solutions really to individual investors and families. So I've been kind of at it on my own here since 2008, but have a long background in the business as a trader, investor, and investment manager and advisor.
Okay, so you know, this is our first show here. We're going to have a series of shows, but the first one is about, you know, what is it, a financial advisor? What, you know, what do they do? What do you do?
Sure. Well, I guess financial advisor can mean a lot of different things to different people. It's as you probably know, it's a term of art that is used by financial planners, investment managers who work with retail investors, as well as retail brokers. But really, the key things that we do in our practice are built around providing planning for individuals and families, and then providing investment management solutions on either a discretionary or a non-discretionary basis. In other words, we work with people to figure out their needs and goals and develop a plan, and then we work to develop that plan with a specific investment solution that we then implement and manage for them.
So what different types of financial planners are there? I mean, is there, what certifications? What is it? How does it work?
Well, I guess there's a range of certifications, and there are also a range of compensation models. On the certification side, anybody that holds themselves out as an investment advisor has to be registered either with the state in which they operate or with the Securities and Exchange Commission as an investment advisor representative as part of an investment advisory firm. So that's kind of a regulatory designation. And then there are professional certifications that many advisors obtain to demonstrate that they have knowledge and training and expertise in their particular area. The two most common that we see in our clients kind of look for with their planners and advisors are the CFP designation, which is essentially geared primarily towards planning and basic level of advice. And then the CFA charter, or Chartered Financial Analyst as it's sometimes referred to, designation, which is a more exhaustive certification process that takes 3 years, that looks at planning both on the individual and the institutional side, investment analysis, investment research, and portfolio management. And then there are a number of other designations as well that have sort of varying degrees of kind of training and expertise required. So that's kind of on the designation side. And then on I guess the other thing that you asked about was sort of the different types of advisors, and I think that's a really important point to kind of draw the distinction between the two main types that you see in retail financial advice. On the one side, you have commission-based advisors who essentially are advisors who are compensated by the products that they sell and by the investments that they transact on behalf of the clients. So they're generally established as broker-dealer representatives. And then there are fee-only advisors, and fee-only advisors are paid strictly based on the advice that they provide and for the assets that they manage. So those are kind of the two main distinctions within the retail financial services between the types of advisors.
So do you need to be like SEC certified, or you have to be? So you can trade, right? So do you have to go through a different level of analysis for that, or?
No, there's really no certification process with respect to the regulators for either providing portfolio management or advisory services per se, other than the requirement to be registered as an investment advisor representative. There is an exam that's involved in sort of achieving that designation, but it's really not a professional certification as much as it is a license to practice. If someone were working actually transacting securities or selling securities to retail investors, then they also have to be registered as a broker-dealer registered representative. And that's a different examination process that requires them to essentially become knowledgeable with the securities laws at the national and state level. But for just investment advisory services, investment management, the only designation requirement is the requirement to be an investment advisor representative. And in some states, like in California, for instance, if you have a professional designation, like the CFA charter, for instance, or the CFP designation, then that examination requirement is waived. I actually did things in reverse order. I started out and obtained my license before I did the work for the professional designation, because I did the professional designation relatively later in my career. So I actually did the examination and then ended up taking another examination to do the certification process.
So, you said fee-based versus commission-based. What's a typical fee-based kind of scenario? Is it different than, like, a commission-based would be like points on the portfolio? That's how it works?
Yeah, well, commission-based is typically transactionally driven. So if you buy a stock, then you pay a commission. If you buy a mutual fund, then you might pay a front-end load called a transaction fee or front-end brokerage fee, or you might pay a back-end load, which is associated with, for instance, if you see mutual funds that have a C series within their, within the shares that are in your account, then that generally indicates that there's a back-end load or trailer associated with that fund. So the brokers get paid, really by the front-end loads and the commissions, and on the mutual fund by the trailers that are associated with the mutual funds paid by the mutual fund companies. There's also something called the 12b-1 fee, which is included in many mutual funds, which is essentially a distribution charge that's used by the mutual fund company to compensate brokers. So those are the principal ways that brokers, commission brokers, are compensated by their clients. Now, in some cases, you have broker-dealers who also have sort of a hybrid fee model where they may also be charged an advisory, fee in addition to the transaction-based charges. So in certain wirehouses, for instance, with the large broker-dealers, you might see an advisory fee in addition to transaction charges on the that you pay to the brokerage firm for every trade that's in the portfolio. On the fee-only side, there are really two ways that people charge on the fee-only side. One is an hourly-based fee, which is literally paying for time, as you would with an attorney or an accountant or other professional on the financial or legal side. And then the other way is an asset-based fee based on the assets under management for the particular portfolio, particular work that's done. And asset-based fees, can range from as low as sort of 25 basis points for if someone has a particularly large value of their portfolio to 1.5–2% for smaller portfolios. Again, the way that the different advisors charge really depends on kind of their focus and how they manage the portfolio and the different services that they provide.
So, okay, why would someone need a financial planner? I mean, what's the real, reason? I mean, like, you have to be dispassionate about your money and your retirement plans and things like that, and it takes a professional to kind of know what to do. You're not emotionally involved. Is that the kind of part of it?
Well, that's a good question. I mean, first of all, not everyone does need a financial advisor or financial planner. There are plenty of people who, take the time to do the research and planning and work on their own. I think if people take a systematic approach and they're thoughtful about their future needs and goals, and they have a basic understanding of finance and the time value of money and a basic understanding of investments, then it's certainly possible to put together a very credible and workable plan on your own. But it's like any sort of profession or any sort of kind of technical area. It's unless you have a basic level of knowledge, and unless you're working through a lot of these issues on a regular basis, then it may not be the best use of an individual's time. And in some cases, they may not have the knowledge or the time to be able to gain the knowledge to do an effective job. And that's really I would say the main reason that we see people kind of going to an advisor is they get to the point where either they have substantial enough assets where a little bit of additional edge in their investments can make a big difference from a financial standpoint, to where it's really worth taking the time and investing the money to be able to sort of do better on their portfolio. Or alternatively, they get to the point where their needs are sufficient and they haven't taken the time to learn how to do it on their own. And at that point, they decide that they really need professional advice. So it's really kind of one of those two areas. Either they, from a time standpoint, a time management standpoint, they'd rather be spending their time on something different, or from a need standpoint, they get to the point where they decide that they really need professional advice.
Yeah, so basically it's kind of like they wake up and go, oh my God, I'm going to retire. I can't retire. How do I get there? Where's that road? How does that take place and all that stuff? So kind of it's a good segue. When should someone start looking at it for a financial planner? And is it like, for example, if you're over 50, is that too late, or is that the right time? How does that work?
Yeah, really, I think in terms of when to start planning, you can never start planning early enough. When to start working with a planner is really more of an individual consideration that that is a function of their ability to individuals' ability to save and to set aside money, and as I mentioned, their general comfort level with investing. If you want to throw up slide number one, graphic number one, that sort of shows the time value of money and this was just kind of a little thought experiment that we do with clients sometime, where basically we show a contribution of $15,000 a year, which is a lot of money, but it's
right.
Something typical to what we see with a lot of dual income families, with 401ks that are being set aside, that they may invest that much or even more on an annual basis for retirement. And the green, if you look at the green bars, that sort of demonstrates what your cash flow would look like and what your account would grow to if you began investing at age 50. It grows from sort of zero to about $330,000, $340,000, and then we assume in this example that you retire, that the person retires, and they begin to draw down again for sort of the next 25 years. And in the blue example is sort of what happens when you start 10 years earlier. So as you can see, you go right along the same pace for the first 10, 15 years, but then there's a huge acceleration in growth of assets in that back 10 years, and that's really more of a function of continued savings rate and appreciation on the portfolio at a modest rate of return, a 6% rate of return. Well, not all that modest in today's interest rate environment,
Right, yeah,
but,
exactly.
but relatively modest. And as you can see, there's a fairly significant variance between starting earlier and starting later, and that that just speaks more to the need to start planning early, not so much the need to get a financial planner early.
Yeah, and then what's the retirement age on this when you're looking at this?
We basically assume 20 that you're investing for for 15 years if you're 50, and for 25 years if you're 40. So just a kind of a standardized age 65 retirement age, just for comparison purposes. And
then obviously there's a way to kind of ramp up. If you're starting later, you could ramp up by hopefully putting in 20,000 more a year or whatever, and kind of scale it up or whatever you need to do, right? Yeah, that's definitely true. So there's a significant portion of the retirement planning equation is simply saving and putting money aside. But the benefit of starting earlier is that not only do you have longer to put aside the money, so you're putting away less each time, but also you get that benefit of compounding of returns, and you get your money working for you, which is a pretty substantial benefit. When you look at least in the United States, some of the few tax preferences that exist, really are in the arena of retirement savings, with the 401k plans, with IRAs and Roth accounts and 403bs and the various savings vehicles that we have available to us. Yeah, and then I also would imagine, it gives you, if you're starting earlier or you have 15 years to do that, that normalizes, like in today's climate, it's been a malaise for 6 to 7 years, and if you just started 7 years ago, it's a kind of different kettle of fish a little bit, I would imagine. Yeah, that's a really good point. I mean, one of the benefits of investing smaller amounts over longer periods of time, one of the benefits is that you get that benefit of averaging through different market cycles. So the risk in sort of taking a big pile of money and investing it all on one day or all in 1 year is that if you happen to be in a market cycle that's unfavorable, and where the opportunities for return are not as kind of attractive as they are at other parts of time, then you may experience a loss, and it may take longer for your capital to recover. And of course, we never know in advance when those periods are going to be. So that's why a lot of people talk about, and we utilize averaging of portfolio risk in order to minimize that variance, minimize that exposure. The idea is we're not trying to time the market, we're not trying to call the market, we're just trying to smooth returns over time. So basically, it's kind of like a steady, slow course of action that kind of keeps that slow build going up, so you're not in any risky environment at one point. So how do you normally assess a client's needs at that? Well, there's some standard measures that we use, and some standard metrics that really apply to most clients. We look at their stage in life, how old they are, what their retirement goals are, what their spending goals are. They're not identical for every client, but we tend to find, at least with individuals, common goals amongst a number of clients. I mean, most people want to retire. They want to provide for their children's education. Maybe they're planning for a major expenditure in the future. They want to be able to travel when they retire, or they maybe have children, and they need to provide for for their expenses later on. So a lot of kind of major life expenses like that they need to plan for. So we generally start with trying to kind of establish a baseline for our clients' initial needs and goals, their income and their expenses, and from that we put together a what we call a lifetime financial analysis that really looks at their overall income and expense and investment needs and goals over a period of time, really over their lifetime. And so that's kind of the just from a mechanical standpoint, what are their what are people's financial needs, just in terms of what they expect to spend and what they're making right now. And then there's a kind of a softer component, which is really individuals
kind of appetite for risk, and sort of their willingness to take risk, and that's really more of a kind of a holistic question that is really more about the individual and their personality and their comfort level with risk and time horizon. And we integrate those various factors together to develop what we call a risk profile, and that risk profile again is on the one hand individuals' risk capacity, which looks at their ability to take risk, and then their kind of their risk propensity or willingness to take risk. And the two of those things put together really kind of develops the risk profile. And then that really drives the rest of the investment process, because once we understand really what a client's needs and goals are and what their risk profile is, then it's fairly it's fairly easy to put together a portfolio that is targeted towards those needs and goals.
Yeah, so for example, if I say something like, oh, I want to make 15% on my money, I would be in the, oh my God, you're in the high risk, let's invest in startup kind of funds, versus I just want to, I'm happy with what I have, I'm just trying to keep it and keep with inflation, right? So that would be two different risk aversions at what you're saying, right?
Yeah,
something
actually.
Like that.
Actually, well, you kind of highlight an important point, because what we actually find a lot of times is that people want the 15% return with no risk, which kind of gets into the kind of the area of managing expectations and setting realistic expectations. One of the things that we do with every client is in the risk profiling process, we try during that process not only to gather information about them, but also to educate clients about what we believe to be reasonable given the current market environment. And in today's market environment, if you said, well, I'm looking for a 15% return, I would say, well, then we probably can't take you as a client, because we don't really have any investments that we believe are reasonable investments, even if you were very aggressive, that we think are likely to give you kind of an expected return of 15%. What we try to do is sort of drive the portfolio based on the expected portfolio of risk, and the expected portfolio of risk then drives the portfolio return, because return and risk are directly correlated.
And that's probably what the Ponzi scheme, we're going to give you 20% on your money, and then eventually you find out, oh my God, I have no money to give you. It's all gone to the Cayman Islands or something. Is there a graph that you want me to put up about showing how you assess a client's needs? Would you want me to do that? Graph? Yeah,
that'd be great. I mean, this is a metric that that we use, really in kind of our stepwise approach to looking at client accounts. We've developed it here. We call it the PRIM system. It makes it easier to follow and understand, and it really stands for planning, research and recommendations, monitoring, implementation and monitoring, and basically it's really a mnemonic for us to kind of work through with clients the different steps of the financial planning and investment management process, because really the planning and recommendations doesn't have anything to do with specific investments or specific asset classes. I guess it does include asset classes at the recommendation phase, but it doesn't include any specific investments or specific changes to funds or stocks or bonds or anything that the individual holds. It's really geared more around figuring out what their needs and goals are and constraints, and then making recommendations both in terms of saving and spending, but also in terms of a risk-based asset allocation that's designed to meet those goals. And then in the second part of it, the bottom half, if you will, which is a little bit cut off on the screen, but it says investment management, that's really where the implementation and monitoring comes in. And sometimes we, that's better, thank you. And the implementation and the monitoring is basically where we work with clients to take those recommendations and put them into action through a portfolio allocation, where we do make the specific investments, and then, on an ongoing basis where we do monitoring. And many of our clients, I mentioned at the beginning when you asked about the different kind of scope of services that financial advisors might have. You know, we do both financial planning and investment management, and we don't always do both for every client. So in some cases, a client may come to us and say, you know, we really just want a financial plan. We really want a roadmap on what we ought to be doing, or we'd like somebody to sort of check what we've been doing and, you know, validate that we, you know, that have a reasonable approach. But we plan to do the implementation ourselves. And, you know, and that's something that not all financial advisors do. They're, you know, generally people who kind of hold themselves out as financial planners will tend to do more of that, and then they'll, you know, they'll work with you to develop solutions that you can implement on your own. But it really is, there are sort of distinct, you know, parts of that planning and investment management process, and that's why we tend to break it down this way.
So another way of looking at it would be kind of like you hire an architect kind of for the plans to build a house, and then you get the plans, you provide the plans, and then someone else you know, either build it yourself or you piecemeal those pieces out. So you offer a service that says, okay, we can get you, we'll design the house for you, you know, based on your needs. You 3-bedroom, 2-bath house, and then here you go. Here's the plans. You can take it and run with it if you so desire, or you can come back and we'll implement that plan for you as well.
Yeah, that's actually a great analogy, because it speaks to the, you know, the question you asked earlier about, you know, why people might need a financial advisor. And, you know, I can just tell you from, you know, the experience that I've had with different clients, you know, a lot of times we get called in after the house is half built, but, you know, they forgot to put in the plumbing. You know, sometimes we get called in when, you know, when there's an electrical problem and there's been a fire in a part of the house. You know, and sometimes we get called in from the beginning and people say, we'll drop the plans, and then, you know, we'll go, you know, I've got, you know, somebody that I know that's a builder, and I'll have them do it. So, you know, I don't want to take it too far, but it's actually a pretty good analogy for, you know, for really what we try to do, and really hopefully where the value add is from working with a professional as opposed to doing it on your own.
So is there I'm sorry, I'm losing my spot here. I want to be on screen. Hey, but is there a certain formula for success, or is each person's goals drastically impact how you set that roadmap, or is it, you know, I want to retire and buy a vineyard? No, well,
right.
Not really. You know, I'm not going to buy a vineyard, but I'd like to retire. That would be good, you know. So, is there a way is there a formula how you do that? Is there a methodology for doing that?
Yeah, I think it's a methodology more than a formula. There are, as I mentioned, you know, common goals that people tend to have. They want to retire. They may not want to retire at the same time. You know, we have people who walk in who are, you know, 25 years old and they're ready to retire because they had a, you know, blowout success in their, you know, first 7 years of working in a technology startup. And then we have people who are, you know, 65 years old and thinking about retiring in 10 years kind of thing. So, you know, it's really a broad range. A lot of people, you know, want to plan for retirement, you know, really because they think they need to and should, and they want to provide for the contingency where they might not be able to work even though they may want to. So that part of it is movable because, you know, people don't necessarily know when they want to retire. And then I would say there are a lot of specific situations that we run into that you know, also will affect the financial plan and will affect the investment allocation. So, for instance, if someone, say, works in an industry where their compensation is heavily, you know, affected by the technology market. Let's say they work in a technology startup, and, you know, their income is going to be predominantly, you know, the equity value of their compensation or something like that. Then basically, you know, they should probably have less exposure to, you know, U.S. technology equities in their investment portfolio than someone who, you know, works for the city and has kind of a relatively stable salary and pension. We call that, in sort of investment management, we call that element of the planning process human capital, and sort of the person's human capital as it affects their overall investment portfolio. And in some cases it may be fairly significant, and in other cases it may be inconsequential. So that's just one example of one of the differences that we run into. And then a lot of times there are special circumstances, you know, that we run into that, you know, maybe someone has, you know, fairly significant tax loss carryforwards from, you know, a previously bad investment experience that, you know, will affect their ability to take risk and to, absorb more gains in the future, or other people who are in a situation where they have a lot of tax deferred or tax exempt assets because they've done a particularly great job with their retirement planning. So tax is another factor that differs for individuals. And again, right now we're just talking about individuals. When we get into sort of our broader practice and working with small businesses and nonprofits, then the factors multiply. So there's definitely a set of common factors, but then a lot of details that that we look at and consider and differ for the different different types of clients that we see.
So I just got a question. What about people that kind of viewed their home as their retirement plan, where the equity, say, like I live in the Bay Area, right? And people bought houses, and the price of houses went through the roof, and then all of a sudden, boom, real estate kind of tanks, and they never really planned for that. How do you kind of balance that part out, or how do you do that?
Right. Well, I mean, I guess where that kind of factors in is really two main areas. One is in the financial planning process, directly when we're looking at individuals' needs and goals and cash flow requirements, whether or not they have kind of significant portion of their income is allocated to housing, and sort of the duration of that obligation oftentimes plays into their retirement calculation. So we often run into a situation where people kind of time their retirement with their ability to sort of pay off their mortgage and kind of eliminate housing expenses is a significant portion of their kind of their income expense requirement. And then in other cases, I think what you're referring to is a situation where maybe somebody decides that they want or has planned to downsize, and possibly take the equity out of their home to either fund future retirement spending, or to enable them to just plan to downsize to reduce their housing expense, and then take out equity. And you're right that the sort of the collapse in the housing market in 2007, 2008 has upset a lot of retirement plans in that way. I think it in addition to kind of the very real impact on household wealth, it's also caused a lot of people to get nervous about their ability to afford retirement. So a lot of what we've been doing in the last year and a half, I would say, is really working with people to actually sit down and map out what their finances look like, to see if they can afford and when they can afford to retire. In a lot of cases, people are actually more well off than they thought, and the house was kind of less of a consideration as than maybe they thought, because again, if they've done a good job in sort of setting aside assets in their 401k and in their IRAs and some of the tax deferred retirement plans, then it tends to balance things out. But you're right that it's been the collapse of the housing market has had a huge impact on people's real asset base, as well as their kind of their sentiment and sort of philosophy about taking investment risk.
Yeah, people would tend to get a little bit gun shy. But so in today's financial climate, how do you keep what you have and grow your nest egg? I mean, how do you do that? Because all the rules, people are shy. The market is kind of a very reactive environment. It's not a it's a perception-based environment. It might not be real, and people get scared very easily.
Right. Well, I always like to tell clients that there are really two drivers of investment returns, and it doesn't matter what the asset class is, whether you're talking about equities or bonds or real estate or any type of asset class. It's really driven by two factors, by value factors, which are really what something is ultimately worth, and sentiment factors, which is what everybody thinks it's worth in the meantime. Actually, Warren Buffett has a great quote for this that's I don't know if he actually coined it or if he kind of adopted it from somebody else, but he says in the short run the market is a voting machine, and in the long run it's a weighing machine. And that really kind of captures the essence of those two kind of opposing forces, and particularly in a situation where you have pretty big dislocations, then they really are, diametrically opposed, because, sentiment tends to get extremely one-sided, and especially in a bear market or in a negative market environment, everybody tends to get very negative at the same time. And when you're talking about things like equities and asset prices that are volatile, after a market has declined and after prices have dropped a lot, is really the time when value, when the other side of that equation, when that long run side of the equation, becomes more tangible, and where basically the from a long-term investment standpoint is really when you should be acquiring assets. So it's a kind of a simple analogy is if you walk into a store and are thinking about buying a shirt for $50, and the next day you walk into the store and can buy it on sale for $25, well, the first day maybe there hasn't been a sort of a crisis or some sort of event that has caused the sale, but the second day there's no question that you're getting better value, but you may not like the shirt because it's if it's on sale for 50% off, then maybe it wasn't that good of a shirt. So that kind of that kind of dichotomy between sort of sentiment and value kind of plays out in asset markets all the time. And what we try to do with our clients, and whether we're actually managing portfolios for people, or whether we're giving them advice on how to implement recommendations directly, is to take a very kind of a long-term balanced approach, and not to let take account of both value factors and sentiment factors, but not to let the either one really influence the asset allocation too much, or towards a single area. Because the one thing that the market consistently does is it consistently surprises. So usually when people think, oh my gosh, we're in a horrible period, and Europe's falling off a cliff, and commodities prices are collapsing, and go to the bunkers, that's usually when you walk in and the market's up 200 points like it was today. So that I think that what we try to do is establish a diversified long-term asset allocation plan for all of our clients that is consistent with their risk profile. And part of that being consistent with the risk profile is being able to ride out the volatility of the market, and be able to ride out those ups and downs without getting pulled around too much by the sentiment.
So we have this graph here. It's called the periodic table of investment returns. Is that what you're basically talking about here? And
yeah, this is one of my favorite graphs, and it's a little bit hard to read. But if you'd like a copy of it, just email me at the end of the broadcast. I'll be happy to send it to you. It basically shows the blue boxes are equity subtypes, and the green boxes are fixed income or bond subtypes. And then the gray, you'll see the gray that's kind of right in the middle there, is a blended portfolio of equity and fixed income. And really the point, each of these boxes actually has a description of what the underlying subclass is and what the return was for the particular year, going from 2001 to 2011. And that's kind of interesting. But what's really interesting to me anyway is that this is a mosaic, and in different years, different asset classes will perform totally variably compared to previous years. And in some years you'll get kind of a period of streaky performance where, for instance, between 2002 and 2007, the emerging market equities were kind of the best performing asset class every single year. And then in 2008, it was one of the worst performing asset classes. But the real point is that by sort of being diversified, by trying to cover all bets, if you will, that's where you end up with the gray boxes. And the gray box is really where you want to be, where you've got kind of reasonable returns, not not going to cover off the ball every year, but having reasonable returns on a regular basis, through diversification of different asset classes. So that's what we attempt to do. We don't promise to do it. We don't guarantee returns. We don't guarantee the performance of any, asset class, and any investment manager that does that, probably run the other direction. But what we do try to do is make sure that our clients have, a very well diversified portfolio, and really diversified by risk type, because what this mosaic shows is that there really is a wide range of kind of returns for the different types of risk type, and it does vary over the years.
So basically, it's like a racket. I don't mean like a racket, but like a tennis racket where all the strings meet, and then the sweet spot is the gray area. And when the ball hits there, that's when you're getting the consistent return, so to speak, right? So
Right.
what would be what do you think is a good return in today's market? I mean, just a realistic return that and on a scale of 1 to 10, when people are have a risk aversion of I just want to kind of keep, maybe make would it be 4 or 5% on your money, or is it even lower than that these days?
Yeah, that's a good question. So we we
Without
generally
putting you on the spot.
Yeah, no, that's
Yeah.
fine. I mean, we get this question all the time. We generally start, what we do is develop sort of what's called capital market expectations for the different asset classes by risk type. So we start with the risk-free rate, which is, literally sort of overnight treasury rate risk, which right now is about 0, right? I mean, they
Right.
don't get paid anything for kind of investing in overnight treasuries. And in fact, even if you invest in 2-year treasuries, you get paid almost 0. You get paid like 25 basis points. And then every other asset risk type basically gets priced as a spread to that benchmark risk-free rate, based on the level of risk. On the fixed income side, the two main risks are duration risk, or how long the maturity is, and credit risk. And then on the equity side, it really depends on the individual asset market, whether it's sort of U.S. small cap or large cap or growth or value or whatever. And then international markets obviously tend to be more risky, with emerging markets being the most risky of the international side. So the way that we look at it, and sort of using that sort of benchmark, we're kind of figuring that the risk premium in equities on a blended rate is probably around 6 or 7%. There's actually been sort of a kind of an expansion of risk premia in certain asset classes recently, as volatility has gone up and as markets have sold off. And so if you then say, okay, well then what does that look like in terms of a kind of a blended portfolio, a 50-50 fixed income equity portfolio, then you're probably looking at around 3.5–4%. If you kind of look at sort of a 2% long-term fixed income and a sort of a 7%-ish type blended equity return. So we're generally using sort of 4 or 5%, 4% for moderate type portfolios is kind of a long-term expectation, and that's also kind of consistent with sort of a 3-ish% real rate of return if you figure kind of 1% inflation over time. So again, it's not a science, it's more of an art, but that's kind of our what we're using right now for assumption purposes. And then one of the things we try to do is parameterize around that when we're kind of doing scenario testing and looking at different alternatives for people.
Well, that sounds like it's hard to balance that, and again, you get into that risk aversion thing, and and it changes as you get older. Your aversion for risk is less, I must admit. Do you have any last thoughts on today's show and going forward?
No, I just like to thank you for the invitation to participate, and I hope hopefully this was useful to people, to kind of give them an overview of what advisors do. One thing I just like to kind of leave your viewers with is that if you are considering working with an advisor, then it's really important to really put them through a diligence process, just the way you would with with any other major relationship that that you're considering. If it's an attorney or I mean, frankly, a contractor, or any other sort of major kind of employee that you're considering bringing on board to help you. Run them through a drill to make sure that they are going to deliver what you need, and that that they're going to provide what kind of what your goals are from from a planning and investment management standpoint. And we've actually put together a kind of a one or 2 page piece called 10 questions to ask before choosing a financial advisor. It takes the 10 questions that the CFP board of standards has developed for assessing financial advisors, and it kind of it includes our answers to those questions, not so much from the standpoint of our particular firm, but from the standpoint of things that you should look for as in terms of best practices and retaining an advisor. So if you'd like to see that, then you can email me or take a look at our website and download it there. But many people have told us that they found that helpful, not only in sort of when in talking to us, but in sort of conducting their due diligence across advisors.
Okay, so why don't you just go ahead and say the name of your website, because I didn't put anything up there that said that, so that would be helpful.
So the website is www.northcapital.com, and you can email me at jdowd, D-O-W-D, @northcapital.com.
And again, people can also comment on this posting, and then we'll forward it to Jim as well, in case you have any questions for any future shows. So, Mr. Dowd, thank you so much. This was a fun little show, and hopefully we can do this again. I'm just going to run this little exit pre-roll, and then we'll end the broadcast, okay?
Great. Thanks a lot.
Thank you.